All right, let's get right to it. We're looking at the 2025 housing market, and I have to tell you the data coming across my desk is deeply concerning. This isn't just a cooling off period, some gentle correction after a few years of frantic bidding wars. No, this is different. The foundation is showing cracks, and in some places, it's threatening to split wide open. We're seeing warning signs that feel eerily familiar to anyone who remembers the chaos and the financial pain of 2008. In fact, some of the numbers we're tracking suggest this could be an even more complex, more localized, and for some families, a more devastating downturn. The story isn't just about interest rates anymore. It's a perfect storm of factors brewing in specific pockets of the country. What's really happening here? What's pushing home prices that once seemed unstoppable right off a cliff? Why are we hearing from homeowners, regular families who are suddenly facing insurance bills of $10,000 a year, or having their policies dropped entirely? These aren't just numbers on a spreadsheet. This is real-world financial pressure that's becoming unbearable for millions. We need to look closely at the map because this isn't a uniform national event. It's a series of local crises, each with its own trigger. Which cities are at the absolute tipping point, where the dream of homeownership is turning into a financial nightmare? The data points to some very specific, and in some cases very surprising metropolitan areas. Today, we're going to dive deep into that data. We're going to go beyond the national headlines and put 10 specific US cities under the microscope. These are the places where the market is flashing the brightest red warning signals for 2025. We'll break down the unique pressures each city is facing, from investor pullbacks and insurance meltdowns to crippling affordability and the quiet threat of climate change. This isn't speculation, this is about connecting the dots, following the numbers, and giving you the unfiltered story of a housing market that is in serious, serious trouble. Let's get to the map. Our first stop is Miami, Florida. Look, on the surface, it's all glitz and glamour. You see the skyline, the turquoise water, the seemingly endless stream of cash flowing into luxury condos. For the past few years, Miami has been the poster child of the pandemic housing boom. Prices didn't just climb, they launched into orbit, fueled by out-of-state buyers and international investors looking for a piece of the sun-drenched paradise. The narrative was simple: Miami is invincible, a global destination where real estate is as good as gold. But that narrative is crumbling, and it's crumbling fast. The numbers tell a story of a market stretched to its absolute limit. The median home price here has become completely detached from local wages, creating a chasm of unaffordability for the people who actually live and work in the city. But the real gut punch, the factor that's pushing this market to the brink, is the insurance crisis. It's not just a problem, it's a full-blown catastrophe. We're talking about homeowners whose insurance premiums have doubled, tripled, or even quadrupled in a single year. Some are being quoted rates of over $10,000, while others are finding it impossible to get coverage at any price. Think about what that does to the financial calculus of owning a home. A mortgage payment that was once manageable is now suffocating under the weight of an astronomical insurance bill. This is the tripwire. It forces people to sell, it spooks new buyers, and it's happening at the same time that the very real, very tangible threat of sea level rise and stronger hurricanes is making insurers flee the state. They look at Miami, and they no longer see a good investment. They see an unacceptable level of risk. This isn't just about the weather, it's about the money. When insurance becomes unaffordable or unavailable, the entire housing market becomes uninsurable and unmortgageable. Banks won't lend on a property that can't be insured. This is how a market seizes up. The high-flying investors who chased quick profits are now looking at their spreadsheets and seeing rapidly diminishing returns and escalating costs. They were the first ones in, and you can bet they'll be the first ones out, leaving a glut of overpriced condos and a trail of financial devastation in their wake. So when you look at Miami, don't just see the flashy skyline, see the fault line running right beneath it. This isn't a gentle correction we're forecasting. The dynamics here are primed for a chaotic, flashy collapse that mirrors the city's own persona. The warning signs aren't just on the horizon, they're here. The tide of money that lifted all boats is receding, and we're about to see who's been swimming without a life raft. Now let's shift gears and travel north to Detroit, Michigan. The story here is completely different from Miami's, but in its own way, just as precarious. For years, Detroit was the symbol of post-industrial decline, but recently, a new narrative took hold: the comeback city. There was a revitalization downtown, a burgeoning arts scene, and a housing market that was, for a long time, one of the most affordable in the nation. This affordability was its greatest asset, attracting new residents and investors who saw potential and value. But that very affordability is now a trap. The problem is, even affordable has become unaffordable for many. While Detroit's home prices are low compared to the national average, they've risen dramatically in recent years, far outpacing the slow-to-recover local wages. The median income in Detroit simply hasn't kept up, and now, even modest homes are out of reach for a significant portion of the population. This isn't a crisis of million-dollar condos, it's a crisis of $50,000 homes that families still can't secure a loan for. It's a crisis of fundamentals. And then there's the other side of the coin, the persistent, haunting issue of urban decay. While downtown and midtown have seen investment, many neighborhoods are still grappling with the legacy of abandonment. We're talking about entire city blocks with just a handful of occupied homes surrounded by vacant lots and derelict properties. This blight drags down property values for everyone, making it incredibly difficult for homeowners to build equity. It creates a ceiling on appreciation that you just don't see in other markets. The economic headwinds are also a major factor here. Detroit's economy is still heavily reliant on the automotive industry, and as we see shifts in that sector, layoffs, plant closures, the transition to electric vehicles, the city remains vulnerable to economic shocks. High unemployment and underemployment are persistent issues that directly impact the ability of residents to buy and maintain homes. A single major layoff can send ripples of distress through the entire local housing market, leading to a fresh wave of foreclosures. Unlike Miami's potential for a sudden dramatic crash, Detroit is facing something different, a long, painful, grinding deflation. This is a slow-motion crisis where prices stagnate or slowly decline, trapping homeowners in negative equity for years, maybe even decades. It's a market where the dream of a comeback is being choked by a persistent lack of economic opportunity and a housing stock that is, in many areas, crumbling. The risk here isn't a bubble bursting, it's the air slowly and inexorably leaking out, leaving a community gasping for financial breath. Let's head back west to the desert, to a city built on spectacle and risk, Las Vegas, Nevada. Vegas is a city of extremes, and its housing market is no exception. It experienced one of the most brutal collapses in the country back in 2008, a true ground zero for the foreclosure crisis. Then, after a long recovery, it rode a tidal wave of post-pandemic demand. People flocked to Vegas for its lower taxes, sunshine, and relatively affordable cost of living compared to neighboring California. Prices surged, and it felt like the boom was back for good. But the house of cards is starting to look wobbly. A huge portion of that recent boom was driven not by families moving for a new life, but by institutional investors and iBuyers. They saw an opportunity to snap up properties and turn them into rentals or quick flips. For a while, it worked. But now, with higher interest rates and a cooling rental market, those investors are getting nervous. Their profit margins are shrinking and their models are breaking. We're seeing clear evidence that they're pulling back, and in some cases starting to offload their portfolios. This is critical because when a market is heavily dependent on investor activity, it's incredibly vulnerable to a sudden reversal. When the big money decides to leave the table, it creates a supply shock. Suddenly the market is flooded with homes for sale, just as regular buyer demand is weakening due to high mortgage rates. This is exactly what we're seeing in the data for Las Vegas right now: rising inventory, longer days on market, and an increase in price cuts. The frenzy is over and the hangover is beginning, and you cannot talk about the future of Las Vegas without talking about water. The city is in the middle of the Mojave Desert, dependent on a shrinking Lake Mead and a Colorado River system in a state of perpetual crisis. This isn't some distant, abstract problem anymore. It's leading to strict water restrictions and rising utility costs. It's a massive, flashing red light for long-term sustainability and growth. How do you convince people to move to a city where the future of its most essential resource is in serious doubt? This climate stress adds a layer of risk that you can't just fix with interest rate cuts. Las Vegas is a classic boom and bust town, and its housing market lives and dies by that cycle. The post-pandemic surge created an illusion of stability, but the underlying fundamentals were always fragile. The combination of investor pullback, rising vacancies, affordability challenges for locals, and the immense pressure of climate change creates a potent cocktail for a serious downturn. Vegas bet big on growth, but the data suggests that for 2025, the house is about to lose. Just a short flight from Vegas, we find another desert metropolis facing a similar, yet distinct set of challenges: Phoenix, Arizona. For years, Phoenix has been one of the fastest-growing cities in the United States. It was a magnet for retirees, young families, and corporations, all drawn by the promise of endless sunshine and affordable living. The housing market reflected this explosive growth, with home prices in the Phoenix metro area consistently posting some of the highest year-over-year gains in the entire country. It was a seemingly unstoppable juggernaut, but that rapid growth sowed the seeds of its own potential downfall. To meet the insatiable demand, home builders went into overdrive, blanketing the desert landscape with new subdivisions. Now that fire hose of new supply is hitting a market where demand is rapidly evaporating. High mortgage rates have priced out a huge swath of potential buyers, and the homes that were once snapped up in days are now sitting on the market for weeks, even months. This is a classic oversupply scenario waiting to happen. The numbers are stark. Phoenix has seen one of the most dramatic swings in the nation, going from a red-hot seller's market to a buyer's market in record time. Inventory levels have ballooned, and price reductions are now the norm, not the exception. The iBuying companies, which used Phoenix as a major testing ground, got burned badly here, and their retreat has left a significant void in the market. The speculative fever has broken, and now the market has to stand on the much shakier legs of local, organic demand. And just like in Las Vegas, the elephant in the room is water. Phoenix is in the Sonoran Desert. It's hot, and it's getting hotter. The city's reliance on the stressed Colorado River is a major long-term vulnerability. The state has already been forced to halt new housing development in some areas on the outskirts of Phoenix because they cannot guarantee a 100-year water supply. Think about that. The very engine of growth, new home construction, is being throttled by a fundamental resource scarcity. This is a direct threat to the Phoenix growth model. Phoenix represents a market that simply grew too far, too fast, without enough consideration for its environmental constraints. The combination of a massive, looming oversupply of homes, a sharp drop-off in buyer demand due to affordability issues, and the undeniable stress of climate change and water scarcity puts Phoenix at extremely high risk for a sharp and painful correction. The desert boom is over, and the mirage of endless growth is evaporating in the Arizona sun. Let's return to the Sunshine State, but this time to the Gulf Coast, to Tampa. For a while, Tampa was seen as the more stable, more affordable alternative to the craziness of Miami. It attracted a steady stream of new residents from the Northeast and Midwest, and its housing market experienced a massive run-up in prices. It was consistently ranked as one of the hottest real estate markets in the country. But now, the very same forces that are battering Miami are creating a perfect storm in the Tampa Bay area. The insurance crisis we discussed in Miami is not a localized phenomenon. It's a statewide cancer, and it's metastasizing in Tampa with a vengeance. Homeowners are being hit with staggering premium increases that are completely rewriting their household budgets. We're hearing stories from people whose insurance costs have gone from $2,000 a year to $7,000 or $8,000. This isn't a minor expense. It's a second mortgage payment for many families, and it's simply not sustainable. This insurance shockwave is crashing directly into a wall of unaffordability. The rapid price appreciation of the last few years, combined with today's elevated mortgage rates, has pushed homeownership far out of reach for the average Tampa resident. The median home price is now wildly out of sync with the median household income. So you have a situation where potential buyers can't afford the mortgage, and current homeowners are being squeezed into selling by unbearable insurance costs. This is a recipe for market gridlock and, eventually, decline. And we can't ignore the role of investors here. Just like in Phoenix and Las Vegas, a significant chunk of Tampa's housing stock was bought up by investors during the boom years. They were chasing yield and appreciation. Now the math has changed. Rental growth is slowing, while costs, especially insurance and property taxes, are exploding. The incentive to hold these properties is diminishing rapidly. As these investors decide to cash out, they will add a significant amount of inventory to a market that is already struggling to absorb it. Tampa's story is a cautionary tale about how quickly a hot market can turn cold. It has all the ingredients for a serious downturn, a crippling insurance crisis that's acting like a massive new tax on homeownership, a severe affordability crunch that has sidelined local buyers, and a looming investor exit that threatens to flood the market with supply. The sunny optimism that defined Tampa's housing market for years is being replaced by a cloud of financial anxiety, and the forecast for 2025 looks stormy. Now we move to a pillar of the New South, a sprawling economic hub, Atlanta, Georgia. For decades, Atlanta has been a model of consistent growth, attracting businesses and people with its diverse economy, major international airport, and a quality of life that was, for a long time, very affordable. This steady growth fueled a robust and reliable housing market. But the extreme conditions of the past few years have pushed the Atlanta market into uncharted and dangerous territory. The market is definitively cooling. The bidding wars and waived inspections that defined 2021 and 2022 are a distant memory. Homes are sitting on the market longer, and sellers are having to make concessions. This isn't just a gentle slowdown. The data shows a significant drop in sales volume. What's particularly concerning is the reason behind it. A large part of Atlanta's recent boom was driven by an influx of investors, from large corporations to small-time flippers, who saw the city as a prime location for rental properties. Now those investors are heading for the exits. The same story we've seen elsewhere is playing out here. Higher financing costs and slowing rent growth are squeezing their profits. As they begin to sell off their portfolios of single-family homes, they are adding a wave of inventory that the market is ill-prepared to handle. This investor sell-off is happening at the exact moment that regular homebuyers are being sidelined by the highest mortgage rates in over 2 decades. It's a classic supply and demand mismatch. We are also seeing some troubling signs on the economic front. While Atlanta's economy is diverse, it's not immune to national headwinds. We're tracking a noticeable uptick in foreclosure filings in the metro area. It's not at 2008 levels yet, but the trend line is moving in the wrong direction. This indicates that a growing number of households are under financial distress, unable to keep up with their payments. This is a leading indicator that signals deeper problems within the local economy and housing market. Atlanta's risk is that its reputation for steady, reliable growth created a sense of complacency. The market got overheated and overleveraged with investor activity. Now, with cooling demand, an investor sell-off, rising foreclosures, and broader economic uncertainty, the southern engine is beginning to stall. The correction in Atlanta might not be as steep as in some of the bubble markets, but it could be a long, drawn-out period of stagnation and decline that will catch many who bought at the peak completely off guard. For our third and final stop in Florida, we're not going to a major metropolis, but to a city that represents a different kind of risk, Deltona. Located between Orlando and Daytona Beach, Deltona and its surrounding area became a hotspot for a very specific reason. It was the affordable option. As prices in Orlando skyrocketed, families and commuters pushed further out, seeking more space and a lower cost of living. Deltona boomed as a quintessential commuter town, a bedroom community for the bigger economic engines nearby. This dependence is now its greatest vulnerability. The entire premise of living in Deltona for many residents is based on a financial calculation: save money on the house, even if it means a long commute. But that calculation is now failing on all fronts. First, home prices in Deltona itself exploded during the pandemic, erasing much of its affordability advantage. People who bought recently paid a premium for homes that are far from the job centers. Second, the cost of the commute has soared. Gas prices, car maintenance, insurance, it all adds up. What might have been a manageable expense a few years ago is now a major financial burden. This double whammy, paying a high price for a home and a high price to commute from it, is squeezing household budgets to the breaking point. The value proposition of living in a place like Deltona is rapidly eroding, and we're seeing the results in the data. The Deltona-Daytona Beach metro area is now seeing one of the largest increases in housing inventory in the entire country. The number of homes for sale has ballooned as sellers rush to get out and buyer demand dries up. It's a market that is flipping from hot to ice cold at a breathtaking pace. This is what happens when a market's growth is based almost entirely on being the cheaper alternative. Once that advantage is gone, there's little to support the elevated prices. The story of Deltona is the story of so many exurban and commuter towns across America that saw unsustainable growth during the pandemic. They are on the front lines of this housing correction. They lack the diverse job markets of the big cities to cushion the blow, and their residents are disproportionately affected by inflation and high transportation costs. The risk in Deltona is a market that falls faster and harder than the major hubs it serves, leaving a wave of underwater homeowners in its wake. Let's turn to the energy capital of the world, Houston, Texas. Houston's market is a complex beast. It's a massive, sprawling metroplex with a powerful economic engine tied to the oil and gas industry. For a long time, its key selling point was incredible affordability for a major city. You could get a lot of house for your money. That affordability fueled tremendous growth, with builders putting up new communities at a dizzying pace across the metro area. But this rapid and often loosely regulated expansion has created a unique set of severe risks. The most significant and unavoidable risk in Houston is flooding. This isn't a hypothetical threat, it's a recurring nightmare. Events like Hurricane Harvey showed the world how vulnerable the city's landscape of concrete and low-lying plains can be. The problem is that despite the known risks, development has continued in flood-prone areas. Now, homeowners are paying the price, not just with flood damage, but with sky-high insurance costs. Flood insurance rates are soaring, and in some areas, regular homeowners insurance is becoming prohibitively expensive. This insurance pressure is a slow-burning fuse for the housing market. It directly impacts affordability and the desirability of entire neighborhoods. A home might seem like a bargain until you get the $6,000 annual flood insurance quote. This is changing the home buying calculus for thousands of people. It's a risk that can't be ignored and is now being priced into the market in a very real and painful way for homeowners. On top of the climate risk, Houston is facing a serious oversupply problem. The same building boom that provided affordable housing for years has now tipped into excess. With high interest rates sidelining buyers, the vast inventory of newly built homes is sitting empty. Builders are being forced to offer massive incentives, buying down mortgage rates, paying closing costs, and outright price cuts, just to move their product. This creates a drag on the entire market, as resale homes have to compete with brand new, discounted properties. Houston's market is caught between a rock and a hard place. Its economic fortunes are still closely tied to the volatile energy sector, making it susceptible to global oil price swings. At the same time, it's grappling with a fundamental oversupply of housing and a growing uninsurable climate risk. This combination is toxic. The affordability that once drove Houston's growth is being systematically dismantled by insurance costs and past overbuilding, putting this Texas Titan on very shaky ground for 2025. Now for a city that was once the undisputed king of real estate appreciation, San Francisco, California. For over a decade, the story of San Francisco real estate was one of breathtaking, astronomical growth. Fueled by a world-changing tech boom, even modest homes sold for millions, and the city became a symbol of American prosperity. But the foundations of that prosperity have been shaken, and the housing market is now in a state of unprecedented turmoil. The primary driver of this reversal is the tectonic shift in the tech industry. The era of easy money, massive hiring sprees, and lavish perks is over. We've seen round after round of significant layoffs from the very companies that define the Bay Area's economy. This has a direct, immediate impact on housing demand. The high-income earners who once fueled bidding wars are now either out of a job, worried about their job, or have left the city entirely thanks to the rise of remote work. This has led to a phenomenon San Francisco hasn't seen in a generation, a sustained population decline. People are leaving, and as they leave, they are putting their homes on the market or terminating their leases. This is most visible in the downtown core, where commercial real estate vacancy rates have hit record highs, creating a doom loop narrative that spooks residents and investors alike. But the effect is also being felt in the residential market, with a glut of high-end condos and single-family homes sitting for sale. The numbers are telling. San Francisco has seen some of the steepest price declines of any major city in the country from its peak. While prices are still incredibly high by any normal standard, the trajectory is undeniably downward. For anyone who bought in 2021 or early 2022, they are very likely underwater on their mortgage. The psychology of the market has completely flipped, from a fear of missing out to a fear of catching a falling knife. The future of San Francisco's housing market is now inextricably linked to the future of work and the fate of its tech industry. The city is facing an existential crisis. Can it reinvent itself in an era of remote work and a more sober tech landscape? Until it finds an answer, the housing market will remain under immense pressure. The exodus of people and the decline in high-paying jobs have created a vacuum in demand, and the market is now correcting from a price level that was, frankly, disconnected from reality for a very long time. Our final city is another Texas tech hub, and perhaps the single most dramatic example of a pandemic boom gone bust: Austin. For a few years, Austin was the place to be. It was the darling of the pandemic migration, attracting a flood of tech workers and companies from California and the Northeast. They were drawn by the vibrant culture, no state income tax, and a housing market that at the time seemed like a bargain compared to Silicon Valley. The result was a housing frenzy of historic proportions. Prices in Austin didn't just rise, they went vertical. It was not uncommon for homes to sell for hundreds of thousands of dollars over the asking price within hours of being listed. This speculative mania was fueled by low interest rates, a flood of outside cash, and a powerful narrative that Austin was the next Silicon Valley. But a market that rises that fast, that vertically, is inherently unstable. It was a classic speculative bubble, and now, we are watching it deflate in real time. The correction in Austin has been swift and severe. As mortgage rates climbed, the out-of-state demand evaporated almost overnight. The tech industry, Austin's adopted economic engine, began to cool and announce layoffs, further chilling the market. Suddenly, the frenzy was replaced by fear. Austin now leads the nation in many key metrics of a housing downturn: a massive surge in inventory, a collapse in sales volume, and some of the sharpest price drops from the peak of any city in the country. The pullback from investors has been particularly brutal. During the boom, investors poured money into Austin, buying up homes to use as short-term rentals or long-term investments. Now, with falling prices and a saturated rental market, they are scrambling to sell, adding even more supply to a market that can't handle it. The city is also grappling with the consequences of its own success, as property taxes, which are based on those peak valuations, are now putting immense strain on homeowners. Austin is the ultimate cautionary tale of the pandemic housing bubble. It shows how a powerful narrative can create a speculative frenzy that becomes completely detached from local fundamentals. The city's long-term prospects may still be bright, but it is currently undergoing a painful and necessary price reckoning. For anyone who bought at the top of the market in 2021 or 2022, the road ahead will be very difficult. The party in Austin is over, and the cleanup is just beginning. So there you have it, 10 cities, 10 different stories, but one common theme. The ground beneath the U.S. housing market is shifting in a dramatic and concerning way. From the insurance crisis in Florida and the oversupply in the Sun Belt to the tech exodus in San Francisco, these markets are not just cooling, they are flashing bright red warning signs. The unique combination of factors in each city creates a localized risk that national headlines often miss. This isn't just about interest rates, it's about insurance, climate, investor behavior, and local economic fundamentals. The era of buy anywhere and watch it go up is definitively over. For anyone considering buying or selling a home in these areas or in markets with similar characteristics, this is a moment for extreme caution and diligence. The data we've looked at today underscores the need to look past the curb appeal and dig deep into the numbers. Understand the trends in inventory, price reductions, and local economic health. Most importantly, understand your own financial situation and your tolerance for risk. Making a decision based on the market of 2021 could be a devastating mistake in the market of 2025. This is a time to be informed, not emotional. The coming months will be critical. We'll be watching these 10 cities closely, tracking the data to see how these stories unfold. The ripple effects from these localized downturns could have broader implications for the national economy. The key takeaway is that real estate is, and always has been, local. The dream of homeownership is a powerful one, but in a market this volatile, protecting your financial future has to be the top priority. Stay informed, stay cautious, and stay safe.